paper. Okay. I want to thank the organizers for, first of all, including me in the program and making this alternative presentation arrangement. Okay, so the paper that I'm going to present today is about dynamic pricing regulation and welfare in insurance markets, and it's a joint work with Naoki Aizawa, who's also in the Zoom room with us. All right. Okay, so the primary role of insurance is to ensure idiosyncratic risks such as health and mortality risks and disability shocks that are faced by individuals. And substantial progress has been made to understand the quantitative importance of these risks and how to better design relevant government policies. Now, very scant attention has been given to financial uncertainties that are faced by insurance companies. So, for example, insurance companies operating in new markets, such as the Affordable Care Act marketplaces, face a lot of risks because they're dealing with consumers that they had never served before. And also insurance companies selling long-term contracts face a lot of uncertainties because many things could unfold over the lifetime of the contract that could potentially affect their future claims costs. Okay. Now, why should we care about this? Financial uncertainties that are faced by supposedly risk-neutral insurance companies? Well, that's because they might pass through this risk to risk-averse consumers by adjusting premiums ex post, especially if the insurance companies have market power. Now, when this happens, consumers end up facing financial uncertainties that are generated by not just their own idiosyncratic risks, but also premium volatility. And concerned about this double layer of financial uncertainties, the government has increasingly adopted regulations that limit insurance companies' ability to revise rates ex post. And that's what we refer to as the rate stability regulation or dynamic pricing regulation. However, almost nothing is known about the welfare impact of such dynamic pricing regulation. And that's where our paper comes in. So the benefit of the regulation is that it could reduce uncertainty about future rate increases, which is going to be valuable to risk-averse consumers. But the potential cost of the regulation is that it could reduce insurance companies' expected profits to the point that it triggers insured exits. And also, if insurance companies cannot effectively increase rates ex post, then they might just start with a higher initial rate, which is going to result in higher markup. So quantifying this trade-off is really at the heart of this paper. All right. Okay, so here's the overview of the paper. So we're going to study the welfare impact of dynamic pricing regulation in the context of the US private long-term care insurance market. And I'll tell you in a minute why this is a good setting to study this question. So we are first going to start by providing descriptive evidence on the impact of dynamic pricing regulation. And we find that the regulation did improve premium stability, but it came at the cost of reduced insurer participation and also product variety. And to quantify this trade-off, we are going to develop an estimate on equilibrium model that's going to feature insurance companies' entry and exit and also dynamic pricing decisions and consumers' insurance choice. And using the estimated model, we are going to run counterfactual policy experiments and examine the welfare impact of pricing regulations. And to give you the preview of the result, we find that the current rate stability regulation in the long-term care insurance market is too strict, and relaxing the regulation to a certain degree would actually increase the overall social welfare. And to give you the quick intuition behind the result is that, so once we relax the regulation, it's true that consumers are going to be worse off due to higher premium volatility, but they're going to be compensated by having access to greater insurer variety, okay, such that the net effect on consumer welfare is close to zero. But you will increase insurance companies' profits because they're going to face lower regulatory costs, such that the overall social welfare is actually increased by having a regulation that's less strict.
Sorry, what's the main here? Oh, let me just touch on
the bottom there.
Okay, sorry. What is my here question? In the healthcare literature, people talk about reclassification risk, and this seems to be that, or is there any difference related to that?
Right. Okay, so that's a great question. So in this market, there's no individual reclassification risk in the sense that insurance companies cannot increase rates just because the individual has gotten sicker. Okay, but what they can do is they can increase the rates at the buyer cohort level. I think that's the main difference, because most of the reclassification risk that the literature talks about is usually about increasing rates at the individual level, but in this market, that's not allowed. All right. So here's the outline for the rest of the talk, and let me provide you some backgrounds. Okay, so long-term care insurance pays for formal long-term care services such as nursing homes and paid home care. So you can basically think of long-term care insurance as nursing home insurance. Now, insurance companies selling these contracts do face a lot of difficulty in predicting the future claims costs. And the first reason has to do with the fact that these are long-term contracts. So most people purchase insurance around the age of 60, and they keep paying the premiums, but most of them do not have needs for these long-term care services until they turn 80. Okay, so it takes more than 2 decades for insurance companies to observe realized claims cost and determine if their initial pricing assumptions were correct. Okay. And also the chance of ending up in a nursing home, it not only depends on the health and mortality risk, which is something that insurance companies do have a lot of experience with, but it also depends on the availability of family care and the preference for different types of long-term care and so on. And these are all the things that are very hard for insurance companies to observe or predict. It's a relatively young market compared to, let's say, life insurance. So insurance companies do not have a lot of experience dealing with the claims. Now, it's a small market, so only about 10% of elderly Americans have some form of private long-term care insurance. And the biggest payer for nursing homes in this country is Medicaid, which is a public health insurance program for those with limited income. Okay. It's a highly concentrated market, and only about 4 insurance companies account for 70% of market share. Okay. Now, let me talk about how pricing works in this market. So there are certain characteristics that insurance companies commit to. So all policies are guaranteed renewable. So as long as consumers pay premiums on time, insurance companies cannot cancel coverage. And like I said, there's no individual reclassification risk. Okay. However, insurance companies do not commit to a certain premium schedule. Okay. And instead, they always reserve the right to increase rates exposed at the buyer court level. Okay. So if the insurance company can successfully persuade state regulator that they need a rate increase, then they can go ahead and increase rates at the buyer court level. Okay. And there have been very frequent and substantial rate increases in this industry. So about 1/2 of the plans in our data had a rate increase over the lifetime of the contract. And the cumulative increase was more than 60% relative to the initial price. All right, so this slide shows you how the supply size has changed over time. So in the left figure, I have the number of active plans. So these are plans that are enrolling new consumers. Okay, so the market really took off in the late 80s. It reached its peak in the early 2000s. Okay, and then we started seeing this very sharp decline in product availability. Okay, and on the right, we have the number of active insurance companies. So these are companies that are enrolling new consumers, and the same trend is observed. So the market started declining since early 2000. Okay, so nowadays you can only find about 10 insurance companies willing to sell this coverage, whereas there used to be well over 100 insurance companies selling long-term care insurance contracts. Now, this very sharp decline in supply size that we just saw coincides with the time when some very important changes regarding pricing regulations took place. Okay, so the oversight of the long-term care insurance market is largely the responsibility of the states, but all states regulate their market based on national standards that are established by the NAIC, National Association of Insurance Commissioners. Now, in 2000, major revisions were implemented to these national standards with the goal of improving rate stability. So it basically, they basically imposed stricter requirements for insurance companies to get their rate increase request approved. Okay. Now, it was completely up to the states to determine whether they adopt these new standards or not, but a lot of them did. So between 2001 and 2012, a total of 41 states adopted the new standards. And the number of states adopting the regulation reached its peak in 2003. And that's when we started seeing this very sharp decline in supply. Okay, now we are going to exploit this variation in adoption of the regulation across states to provide some descriptive evidence. Okay, so we are going to adopt event study framework, and we are going to look at 2 years before and after the adoption of the regulation at the state calendar year level. And the main data set for this paper comes from the regulatory filings submitted by the universe of long-term care insurance companies that operate in the US. Okay, and our sample period is between 2000 and 2007. Okay, so here's the regulations impact on the number of active plans that are offered on the market. Okay, so we see that it negatively impacted the product availability. So in 2 years since the adoption of the regulation, the number of active plans in a given state is reduced by 10, okay, and the average is about 65. Okay. The regulation also negatively impacted insurer participation. So in 2 years since the adoption of the regulation, the number of active insurers is reduced by 2. Okay, and we find that most of these exits are driven by fringe firms that had relatively small market share before their exit. So when I say exit, it means the insurance companies no longer accept new consumers, but they still have to honor their existing consumers. And over our sample period, the bankruptcy rate was very small. Right, so here's the impact on the initial rate. Okay, so we don't see much of an impact on the initial rate the insurance companies set. So despite the fact that it has become harder for insurance companies to increase rates afterwards, they do not start with a higher initial rate. Okay, so we at first we thought this was puzzling, but we think that this might have to do with the initial rate regulation. So insurance companies face regulatory constraints not just when they're trying to increase the rate of their for their existing policyholders, but also when they're trying to set the initial rate for their new policyholders. Okay, and we think that because of the regulatory constraints imposed by the initial rate regulation, we might not find a big impact on the initial rate coming from the rate stability regulation. All right. Okay, so the descriptive evidence that I've presented so far is not looking very good in the sense that the rate stability regulation reduced product variety, and also it had a negative impact on insurer participation. Okay, but this cost has to be weighed against the benefit of the regulation, which is improved premium stability. And for that, we are going to use a different data set that's got information about the rate increases that happened in all 50 states from 2007 to 2017. All right, so let me explain this figure. So in the left, on the horizontal axis, I have the plan age or the contract age at the time of the rate increase request. Okay. On the y-axis, I have the rate increase approval rate. Okay. And the gray line represents the approval rate of plans that were sold before the adoption of the regulation. And the black line represents the approval rate for plans that were sold after the regulation was adopted at the state level. Okay. So we see that the approval rate is indeed lower for plans where the regulation is binding. Now, on the right figure, I again have the plan age at the time of the rate increase request. On the y-axis, I have the ratio of approved to requested rate increase. Now, so for plans that were sold before the adoption of this rate stability regulation, they were getting about 70% of what they asked for. So firms were getting about 70% of the rate increases that they asked to their state regulator. Right? But for plans that were sold after the regulation has been adopted, they're only getting about 60%. Okay, so this slide provides suggestive evidence that the rate stability regulation of 2000 seemed to have achieved its goal of improving rate stability. But to weigh this benefit against the cost of the regulation, which was reduced insurer participation, we are going to develop and estimate a structural model. All right, so we have a 3-stage model. Okay, so stage 0 is going to, that's where we are going to have a firm's entry decisions. Okay? And then we move to stage 1, and that's where firms are going to compete against each other by setting the initial rate. Okay? And then consumers are relatively young in the sense that they are around the age of 60, and they're going to make their insurance purchase decision. Okay? And then we move to stage 2. So this is where consumers are older and finally have the needs for long-term care services. Okay? And firms are going to receive new signals about their claims cost, and they're going to have a chance to increase the rate for their existing buyers. Now we're going to consider 2 types of firms in this model. So we have major and fringe firms. Okay? And we assume that in stage 0, it's only the fringe firms that make the entry decisions. Okay. Now, this is based on the empirical evidence that the regulation only impacted fringe firms' entry and exit, and it did not have a significant impact on major firms that had a relatively large market share. Okay. And also, it's consistent with the industry finding that the number of large players in this market has remained quite steady, despite the huge exits that we saw in the last 2 decades. Okay. Now, after fringe firms make their entry decisions in stage 0, from stage 1 and onward, we are going to assume that there is a representative fringe firm, which we are going to index by capital J, that decides on a single price schedule that all fringe entrants will follow. Okay? So you can think of these representative fringe firms just like any other major firm when it comes to pricing competition. Okay, now, this is admittedly a simplifying assumption that we impose, but it's just that in the data, there are just way too many fringe firms. In some markets, there are well over 100, such that endogenizing all of these fringe firms' pricing decisions would make the model impossible to solve. Okay? Now, this assumption is not completely without empirical support in the sense that the premium dispersion among fringe firms is indeed much lower than that of major firms in our data set. Okay, so now how does the number of fringe entrants that was determined in stage 0 fit into the model? Now we are going to allow for the possibility that consumers' value for contracting with this representative fringe, which we index by capital J, depends on the number of fringe entrants. Okay, so for example, if the regulation negatively impacts fringe firms entry in stage 0, then that's going to lower the consumer's value for contracting with this representative fringe. Okay. So that's how we capture the possible negative impact of the regulation on consumer surplus. Okay. Now, in terms of the policy environments, for the supply side, we are going to have initial rate as well as subsequent rate increase regulations. Okay. And for the demand side, we are going to have Medicaid as means-tested public long-term care insurance for long-term care. Right. So here's the timeline of the model and also some very important assumptions that we impose. Okay, so just to repeat, in stage 0, that's where we're going to have a continuum of fringe firms, and they're going to make their entry decisions based on their expected profits and their entry cost. Okay. And then we move to stage 1, and that's where major firms and the representative fringe are going to compete against each other by setting the initial rate of their long-term contract. And then consumers are going to make their insurance purchase decision, where DIJ is a dummy for individual I contracting with insured J. Okay. Now the assumption that we impose here is that consumers, when they make this insurance purchase decision, they believe there won't be any rate increases over the lifetime of the contract. Okay. Now, why do we impose this assumption? That this is to rationalize the fact that in the data, there are no firms committing to offering a smooth price schedule. But if you think about it, given that consumers are risk averse, insurance companies could maximize their value by committing to a smooth price schedule. And they can just extract the surplus using their market power. But no firm does that. Okay. And we're going to rationalize the absence of this smooth price schedule by assuming that consumers, that they always believe, no matter what firms will actually do in the second stage, they always believe there won't be any rate increases. Okay. Now, with this type of consumers, insurance companies can actually do better by deviating to a different price depending on the realized state of the world in the future. Okay. And this is, we do have empirical support for this. So apparently less than 20% of long-term care insurance buyers knew that their company had raised rates in the past. Right. Okay, and then we move to stage 2, and this is where consumers are older, okay, and firms are going to receive new signals about their claims cost. Okay, so all the variables are going to have the additional subscript of K to realize to emphasize the fact that the realized state of the world is K. Okay? And then insurance companies are going to have a chance to increase the rate from PJ1 to PJK2. Okay? Now, from the consumer side, there are no choices being made. What this means is that we do not allow consumers to switch to a different insurer or different option in stage 2 when consumers are older. Okay? Now, this is because in reality, almost no firm sells coverage to consumers over the age of 75. Okay. And also lapses when contracts are this old are very small. And the literature finds that they're mostly driven by behavioral reasons, where consumers, for example, forget to pay the premiums. So like strategic lapses where consumers walk away from their contract because they learn that they're of better risk than initially expected. That's pretty empirically irrelevant in this market. All right, so let me provide you some more details of the model by going through the payoffs. So consumers, so if consumer I contracts with insured J in the first period, then her consumption will be her income minus the premium, the initial rate that she has to pay to the insurance company. Okay, and U is the utility from consumption, which is concave to capture risk aversion. Now, if the consumer contracts with the representative fringe, which we index by capital J, then her value will also depend on the number of fringe entrants that make up this representative. Okay? And gamma represents the consumer's value for fringe variety. Okay? And xi j is the unobserved initial quality, and we have the choice-specific shocks. Now, insurance companies in the first period do not pay out any claims because consumers are young in the first stage. So they just collect the payments, but they have to deal with this initial rate regulation. So mu j tilde represents the level of price that the regulator thinks is appropriate. Okay, and this is basically how the state regulators monitor the initial rates that are set by insurance companies. Okay, and so they're going to be paying a regulatory cost if their initial rate is different from the target price that's set by the regulator. Right, and now in stage 2, we're going to have state contingent payoffs because there can be many states of the world that could be realized, and we're going to assume that the realized state is K. Now, when the second period comes, there are no actions that are being made by the consumer. They either get to keep or terminate their contract if they choose to be insured in the first stage. And delta K represents the lapse, exogenously given lapse probability. Now, if they do stay with the insurer that they chose in the first stage, then the flow payoffs are very similar to the previous stage. Okay, the only difference is that they're not going to pay the revised premium. But the thing is that in stage 1, when consumers calculate their choice-specific value for contracting with each insurer, they are going to believe that there won't be any rate increases, and they will keep paying the initial rate even in second stage. Now, if they do terminate their contract because they're hit by an exhaustionally given probability, so you should think of it as the case where, for example, the consumer forgot to pay the premium. Well, in that case, they're going to have to deal with the long-term care expenditure shock themselves, which is represented by lambda, and the out-of-pocket cost function. That's going to depend on the consumer's income to capture the means-tested Medicaid. Now, insurance companies in the second period, they're going to have to deal with the claims cost because now the consumers are finally older. They're going to pay out some claims, and then they're going to face this cost function. So this is going to be increasing in the rate increase the insurance companies decide on. Okay, so this of course captures the rate stability regulation. So they're going to pay a higher regulatory cost if they increase the rating, increase the rate. But you should also think of this cost function as capturing the reputation cost, because so the notion here is that consumers in the future are probably going to have a lower value for insurance companies that are known to substantially increase rates. Okay, so this captures not only the regulatory but also reputation costs. Right. So the equilibrium concept is Nash. So consumers in the first stage, they are going to make their insurance purchase decision to maximize their lifetime profits, payoffs. But the thing is that here they're going to have wrong beliefs in the sense that they believe there won't be any rate increases in the second period. Now, given the lack of commitment, insurance company in the second stage, they are going to choose the rate increase that will maximize their second period payoffs. So depending on the realized state of the war and depending on the realized claims cost, they are going to choose the revised premium that maximizes their second period payoffs. And they're going to be subject to this rate stability regulation cost, which also captures the reputation cost. And then insurance company in the first period, they are going to set the initial rate to maximize their lifetime profits. Okay. Now, in stage 0, fringe firms, they're going to make their entry decisions by comparing their expected profits to their entry cost. So the rate stability regulation, it will have a direct impact on the rate increase the insurance company sets in the second stage, but it will also impact the initial rate because of the insurance company's forward-looking behavior, and it will also impact fringe firms' entry decisions. Right, and the descriptive evidence shows that the regulation had a positive impact on the rate increases from the perspective of the consumer, while it negatively impacted insurer variety. Okay. All right. So in the interest of time, let me just give you an overview of the estimation. So we're going to calibrate our estimates of the parameters outside the model. We're going to estimate the demand parameters. So we're going to estimate the scale for consumption utility as well as the consumer's preference for fringe variety by following BLP. Okay, and we're going to use exogenous variations such as Hausman-Niveau instruments and changes in outcomes triggered by the adoption of the regulation to instrument for endogenous prices and the number of entrants. Okay. And then for the supply side, we are going to impose functional assumptions and back out the parameters using the optimality conditions. Right. So let me just spend just 1 minute on going over the estimates. So here are the estimates for the demand side. So alpha is the scale for consumption utility, and gamma represents the consumer's preference for fringe variety. So we see that the estimate for gamma is positive. So what it means is that consumers value having access to greater fringe variety in the market. So if the regulation reduces number of fringe firms in the market, it will have a negative impact on consumer welfare. Okay. Now, let me briefly comment on our alpha estimate, which is going to be crucial in determining the demand elasticity with respect to price. So we find relatively small price elasticity. So what it means is that without the regulatory constraints, insurance companies could actually exercise significant market power. Okay, now let me move into the counterfactuals. So in the paper, there are 3 things that we do. We are first going to look at the impact of changing the strictness of the rate stability regulation. And we also look at the impact of changing the strictness of the initial rate setting regulation. And then we look at the interaction between pricing regulations and the generosity of Medicaid. But for this talk, I just focus on the first experiment because it's really the meat of the paper. So what we do is we change the cost associated with revising rates from 50% to 100% of the baseline and examine the resulting market outcomes. All right, so here's the impact on the prices and the fringe variety. Okay, so in all of these graphs in the horizontal axis, I have the cost multiplier. So if the multiplier is 1, it means that we are using the baseline cost estimate. And if it's below 1, it means that the regulation is less strict. And if it's above 1, it means that the regulation has gotten costlier. Okay. Now, panel A represents the impact on the initial rate. Okay. So we do not see much of an impact on the initial rate. And this is actually consistent with the descriptive evidence that I showed earlier, where we saw that a stricter version of the regulation does really have no impact on the initial rate that's set by the insurance companies. And that's also what we find from our estimated model. Okay. Now, panel B represents the impact on the revised premium. Okay, so if you relax the regulation, then it's going to increase because insurance companies are going to increase their second stage premium by a higher margin if the regulation is less strict. Whereas if the regulation gets more strict, then the second stage premium will decrease. Okay? And to give you a specific number, the doubling the regulatory cost will decrease the second stage price by about 7%. Okay, so from our estimated model, consistent with the descriptive evidence, we find that a stricter version of the regulation improves premium stability. Okay, so again, you should think of this panel B as the benefit of the regulation to consumers. And panel C represents the cost of the regulation to consumers. So if you relax the regulation, then it's going to attract, the market is going to attract more fringe entrants. Whereas if you make the regulation stricter, then you will reduce the number of fringe entrants. And the doubling the regulatory cost will reduce the number of fringe entrants by about 2%. Okay. So the net impact on consumer welfare will really come from this trade-off between panel B and panel C. All right, here's the impact on insurer profits and consumer welfare. Okay, so panel A represents the impact on major firms' profits, and panel B represents the impact on representative fringe firms' profits. Now, not surprisingly, once we relax the regulation, insurance companies' profits will go up, and if we make the regulation costlier, then insurance companies' profits are going to fall. Okay. Now, let me talk about the consumer welfare. So, so if I change the regulatory cost within a reasonable bound, so for example, if the cost remains between 50% to 200% of the baseline estimate, then the net impact on consumer welfare is close to 0. Okay. So what it means is that the benefit from improved rate stability, which comes from the regulation, is completely washed out by the cost from reduced fringe variety. Okay, such that the net impact on consumer welfare is close to 0. But we are not saying that we should get rid of the rate stability regulation, because once the regulatory cost becomes very small, for example, when it's just 10% of the baseline, well, in that case, the revised rate is going to skyrocket, such that it is going to have a negative impact on consumer welfare. Okay, so the policy implication from this slide is that if you relax the regulation to a certain degree, it's not going to negatively hurt the consumer welfare, because they're going to be compensated by having access to greater fringe variety, whereas it will increase insurance companies' profits. Okay? And also, it will increase the number of insurance companies active in the market. And given the unraveling of the industry that we've been seeing, this is something that we think policymakers should care about. All right, so let me conclude. So in this paper, we took a first attempt understanding the welfare impact of pricing regulations in the context of the long-term care insurance market. And we saw that there's a clear trade-off surrounding the regulation, which is the enhanced premium stability versus reduced insurer and product availability. And we find that in the US long-term care insurance market, relaxing the current pricing regulations would actually increase social welfare and insurer participation. All right, so that's all I have.
Well, thank you. So if there's any questions or comments, it's still fine, but otherwise I can go first. Let's just get going.
Thank you.
It's at least 40 minutes until the lunch start outside. So if there's any questions or comments?
I have one. One of the questions I had is the lapse decision is exogenous. Could you endogenize that so that if an insurer raised their rates a lot, you're more likely to lapse? And if you had a right to get a rebate or a refund of your insurance premium, could that create strong incentives for reducing the incentive to raise price at X cost?
Right. So we actually experimented with a model where we endogenized lapses. But the thing is that it doesn't really have a huge impact on the model outcomes because in the data, the lapses are very small. It's like 2%. So yes, because of the very small lapse rate that we see in this industry, it doesn't make a huge difference whether we endogenize or treat lapses as exogenous.
Okay. Oh, we're sorry we can't have you join for lunch, but I guess
Yeah.
someone else. Let's see. I guess it's